in second quarter of 2021, reflecting the impact of the imposition of full movement control order. On a monthly basis, GDP growth improved in April, but subsequently slowed as the surge in COVID-19 cases led to the measure in May and June. In June was not as significant as MCO 1.0 last year, and is comparable to the growth during MCO 2.0 at the beginning of this year. On the supply side, most economic sectors register improvement in growth during the quarter. However, the strength in growth recovery was impeded by the reimposition of containment measure, particularly in June. The manufacturing sector registered a double-digit growth, mainly on account of the continued robust E&E production amid strong external demand. Similarly, record positive growth, driven by higher crude oil and natural gas output amid the recovery in external demand. As for the construction sector, the strong growth was supported by the progress in large infrastructure works. Meanwhile, growth in the agriculture sector contracted during the quarter due as spending improved across necessity and discretionary items. Meanwhile, the expansion in private investment was driven by higher capital expenditure, mainly in the services and manufacturing sector. For the public sector, the electrical and electronic, petroleum and rubber-based products, despite the imposition of domestic containment measure. Meanwhile, the services account recorded a marginally higher deficit of RM 50.4 billion, due mainly to larger deficit in transportation and other business services. In the income accounts, the deficit in the due to higher investment income accrued to foreign companies and investors in Malaysia. With that, I end my presentation. Thank you. Let me now hand over back to Gabenor.
Thank you, Dr. Seri, Dr. Uzir. While the economy continued on a recovery path in April, domestic-oriented activity was affected by tighter containment measures in the later part of the second quarter of 2021. The latest key indicators, which include total transactions encompassing both online and physical spending, and mobility indicators, suggest some tentative improvements in July. However, it remained below pre-FMCO levels. In the labour market, Indicators in the first 2 months of the second quarter showed continued improvement, but the imposition of the FMCO has affected the recovery in June. As a result, employment levels declined in the second quarter to 29,000 persons, while unemployment rate remained elevated at 4.8%. Data from SOCSO also showed a similar trend, where smaller jobless claims and improvement in job placement rates were observed up until May 2021, before worsening in June 2021. While the labour market outlook in 2021 has weakened, the expectation is for the labour market to recover going into 2022, but at a more moderate pace. This is in line with the faster progress of vaccination and expected lifting of movement restrictions, which will support an improvement in economic activity. Growth prospects in the third quarter of 2021 will be weaker due to the continuation of the FMCO. However, growth is expected to improve in the fourth quarter of 2021. On the external front, strong global demand conditions, particularly in major trade partners, and the tech up cycle will support exports and production activity. On the domestic front, a rapid vaccination rate will allow the gradual relaxation of FMCO restrictions and enable the resumption of economic activity. Ongoing policy support for businesses and households, as well as the continuation of large-scale infrastructure projects, will also be key factors underpinning growth in 2021. Thus far, we have seen strong export performance, driven by the strength in external demand. The faster expansion in exports was broad-based across products. Going forward, the rebound in major trade partners' growth is expected to support Malaysia's exports. Malaysia stands for semiconductors to cater to increasing needs for work-from-home equipment, digitalization of businesses, and medical devices. In addition, non-E&E manufactured exports, including petroleum and chemical products, will continue to benefit from the strength in global business and consumer demand. Rubber products will also remain supported by higher healthcare and hygiene requirements in both the medical and non-medical sectors. The strong exports performance would continue to support the recovery in the domestic economy, including through job creation and income growth in export-oriented sectors. Salaries in the export-oriented manufacturing and services sectors grew by 7% and 2.6% respectively in the second quarter of 2021. In particular, the E&E sector is expected to benefit from the ongoing global tech up cycle. Sales of electronic components are projected to record double-digit growth in 2021. Malaysia has been benefiting from this strong demand due in part to our strategic position in global value chains as one of the larger net exporters of semiconductors. Based on the bank's industrial engagements, E&E firms will continue to benefit from the tech up cycle. Several firms are reporting full order books, installing new plants and machinery, and venturing into new products such as data centers and medical devices. Our quarterly bulletin also features a box article titled "The Global Chip Shortage, Implications and Opportunities for Malaysia," which discusses how ongoing global developments impact the domestic E&E sector in further detail. On the domestic front, the rapid vaccination rates are expected to ease demands on the healthcare system, thus allowing for safer and faster easing of containment measures. However, conditions currently vary by states with different degrees of vaccination rates and ICU utilization. Hence, different states are expected to transition to the next phase at differing times. States with low ICU and fast vaccination are expected to transition faster and earlier to phase 4. Slow vaccination rates would contribute to slower improvement in health outcomes. However, as vaccination rate improves and lowers ICU utilization, transition to subsequent phases would be shorter. On the other hand, with high ICU utilization, transition to the next phase would be gradual at first, before picking up as ICU rate stabilizes and improves with higher vaccination rate. With a baseline assumption that existing vaccines are effective against the prevailing variants, resulting in lower ICU utilization, all states are expected to transition to phase 3 by October and phase 4 by November. With the implementation of containment measures would weigh on growth, there are at least two factors which have partially mitigated this fact. First, utilization and automation have continued to gain traction to help cushion the impact of the movement restrictions and support the recovery momentum. In the first half of 2021, the number of online banking transactions grew by 36%, while the number of e-wallet transactions grew by 89% compared to the same period last year. More merchants are also embracing digital payment solutions. For instance, merchant registrations to accept QR payments had increased by 57% to 1 million businesses by the end of June, compared to the same period last year. Sectors also have the highest capital intensity and automation among other manufacturing subsectors. In addition, from our industry engagements, firms address the production gaps while complying with the strict labor restrictions by increasing working days and shifts and deploying new capacity from prior investments. Second, policy measures to assist households and businesses have provided some support to growth, and this include labor market policies, cash relief, and cost reduction measures. Related production. This includes the operationalization of the Petronas Floating Liquefied Natural Gas Dual, or PFLNG2 facility, and the restart of the Rapid facility. The pickup in investment activity is also expected to support growth, underpinned by the continued progress of large infrastructure projects such as the ECRL, MRT2, LRT3, and Pan-Borneo highways, including Jendela, would also spur high value and productive investment over the medium term. Overall, the Malaysian economy is projected to grow between 3% and 4% in 2020. The impact from the implementation of the FMCO nationwide. On a seasonally adjusted quarterly basis, Malaysia's GDP is expected to return to pre-quarter of this year. Export-oriented sectors will see a strong recovery in line with improving global demand. Expected to recover at a slower pace. Demand, ramp up in commodity production. At the same time, we acknowledge that the near-term growth outlook remains uncertain and is highly dependent of containment measures and the materialization of health outcomes, which is contingent on the progress of the national vaccination program and the effectiveness against new variant of concerns. Growth will also be influenced by policy uncertainty and implementation progress of key investment projects. Going forward, these evolving factors, especially the duration and stringency of domestic containment measures, will determine a significant level of certainty to Malaysia's growth outlook stems from how the pandemic evolves. As such, two scenarios are used to illustrate the alternative implications of the pandemic on 2021 growth. A faster recovery scenario assumes a more rapid vaccination rollout, leading to a sooner than expected reopening with a faster vaccination would be fully inoculated by October. This will generate a faster recovery in labour market conditions and consumer confidence, and subsequently, the scenario assumes a delayed reopening of the economy on account of delayed resolution of the pandemic. This scenario assumes vaccination rates would slow down and the efficacy of existing vaccines is lower to new virus strains. This would necessitate a more prolonged containment measures and is expected to weigh on economic activity. These scenarios are described in greater details in our white box on its title, Malaysia's 2021 Growth Outlook, Baseline and Scenarios, in our quarterly bulletin. Nevertheless, Malaysia's growth recovery is expected to accelerate going into 2022. The recovery is in line with further expansion in global growth and trade activity, a key driver for production activities domestically. The normalization in domestic activity will be supported by an improvement in consumer sentiment, catalyzed by an increasing share of the population being fully vaccinated and the ease of the significant build-up in house accelerated since March last year, growing at a monthly average of 20.2% compared to the 2019 monthly average of only 4.1%. In addition, the strength in commodity-related production capacity and faster progress in the large infrastructure projects are also expected to reinforce the growth recovery. Headline inflation recorded a temporary spike to 4.1% in the second quarter. This was due mainly to the base effect from fuel prices and lapse in the impact from electricity tariff rebates implemented last year. Meanwhile, core inflation remains stable at 0.7%. For 2021, headline inflation is expected to average between 2 and 3% as compared to our earlier forecast of 2.5% to 4%. The revision takes into account that headline inflation is expected to average close to the lower bound of the previous forecast range. Importantly, the trajectory for headline inflation remains unchanged. In particular, headline inflation is projected to moderate through the second half of 2021 as the base effect from fuel prices dissipates. Underlying inflation, as measured by core inflation, is expected to remain subdued 1.5% for the year amid continued spare capacity in the economy. While there remain cost pressures from global commodity prices, logistical issues, and idiosyncratic supply disruptions, these pressures are assessed to be temporary. To some extent, the impact of cost pressures on broader prices are also partly mitigated by strong competition and policy measures to alleviate the cost burden, such as the fuel price ceiling. OPR remains at its historical low of 1.75%. For 2021, monetary policy will remain accommodative to provide support to the economy while ensuring price pressures remain manageable. Fiscal and financial measures will continue to cushion the economic impact on businesses and households and lend support to economic activity. Given the uncertainties surrounding the pandemic and the impact to growth and inflation outlook, the monetary policy stance will continue to be determined by new data and information. The bank remains committed to utilize its policy levers as appropriate to foster enabling conditions for a sustainable economic recovery. Turning to domestic financial markets, conditions in domestic financial markets were affected by both external and domestic developments in the second quarter of 2021. On the external front, the decline in US Treasury yields and the weakening of the US dollar led to similar movements in bond yields and an appreciation of currencies in most other advanced and regional economies, including Malaysia. Domestic equities declined due mainly to uncertainties surrounding the COVID-19 developments. Since 1st July, however, the ringgit has depreciated against the US dollar by 1.7%, while the 10-year MGS yield trended lower. Going forward, as uncertainties surrounding the strength of the global and domestic financial markets will continue to experience intermittent periods of capital flows and exchange rate volatility. In particular, this includes uncertainties over the path on the US Federal Reserve tapering of asset purchase program and policy rate normalization. Net financing expanded by 4.4% during the quarter. For the business segment, outstanding loan growth moderated to 1.3%. Nonetheless, loan disbursements remain at a high level, supported by loans for the purpose of working capital. Outstanding housing loan growth moderated to 5.3% during the quarter compared to 6% in the previous quarter. However, demand for household loans continued to be forthcoming, particularly for purchase of residential property. Outstanding financing to SMEs expanded by 6% as at end June, as banks continue to extend their support to SMEs. Financing by banks supported working capital and investment needs of SMEs, with disbursements for both purposes continuing a positive trend since mid-2020. Out of the 154 billion ringgit disbursed in the first half of the year, 98% were from banks' own funds. The remainder, about 3 billion, were from Bank Negara's funds that were disbursed to more than 12,000 SMEs. These were predominantly SMEs in the services sector, most affected by the pandemic. To enhance the facilities under our funds as new developments emerge. For example, in light of the FMCO, two significant enhancements have taken place. Two facilities, namely the Penjana Tourism Financing and the Targeted Relief Recovery Facility, now allow for a proportion of the loans to be used for refinancing SMEs' existing business loans. This allows SMEs to reduce their overall borrowing costs. Non-services sector SMEs National Recovery Plan may now also avail themselves to the TRRF. Previously, this fund was limited to only SMEs in the services sector. Since the start of the FMCO, banks have expanded their repayment assistance programs to cushion the impact of the heightened restrictions and to provide timely help to affected borrowers. The number of applications approved by banks in June and July this year have surpassed the applications approved in the 8 months between October last year to May this year. While this is a significant volume of applications, the proportion of households and SMEs under repayment assistance remains manageable. The banking system has been supportive of borrowers and the overall economy, despite continued uncertainty in the operating environment. The credit risk outlook remains challenging, as some borrowers continue to face financial distress amid the extended period of stricter movement restrictions. In response, banks have sustained their support in providing repayment assistance as well as restructuring or rescheduling options to affected borrowers. At the same time, banks continue to build up loan loss provisions during the quarter, although at a more moderate pace, given preemptive provisioning carried out throughout 2020. Overall, the banking system continues to maintain strong financial buffers to absorb potential credit losses, with ample liquidity available to support financial intermediation activities. Let me now conclude the briefing. Growth improved in the second quarter of 2021, but economic activity was weighed by the FMCO in the later part of the quarter. Growth is expected to trough in the third quarter before improving in the fourth quarter this year, in line with strong external demand conditions and the easing of containment measures. The Malaysian economy is now projected to expand between 3 and 4%. However, the near-term growth outlook is highly dependent on COVID-19 risk factors. Having said that, going into 2022, growth recovery is projected to accelerate, supported by a normalization in economic activity amid a high vaccination rate and continued improvement in external demand. And this is the end of my presentation. I am now able to take questions from members of the press.